Hello and welcome to the grand finale of Business Standards 11 episode 9-day BFSI Summit. Today we have with us Reserve Bank of India Governor Mr. Shaktikanto Das. No, he's not giving the keynote address. He's kind enough to have a conversation with Business Standard in the form of a so-called fireside chat. Sir, welcome to the show and congratulations. You created history. I think Reserve Bank of India's since 1935, no governor has got a second term for 3 years at one go, and you are the second governor to have 6-year term.
Thank you.
So let's start with that, Mr. Das. How challenging is the job? Because you are almost 1 month away from the first 3-year term. Roughly half of it has gone fighting COVID. And many believe that post-economic liberalization, as a governor, you have the most difficult task. I mean, there are difficulties like Dr. Jalan walked in the East Asian crisis. Subbarao had the problem of global economic crisis, post-Lehman. Then Rajan came, current account deficit, high inflation. But yours is something radically different.
You see, for any governor at any point of time, there are a large number of challenges. Now, you have to see the challenges in a particular time context. So it's very difficult to say which was the toughest. Each challenge in each period is as tough as the other one. But yes, this pandemic is perhaps, as people have said, it is once in a century or once in 100 years. So to that extent, it has been majorly and largely challenging. Now, talking specifically without comparing with any other tenure, when I came in, the key challenge for the Reserve Bank was the post-ILFS crisis period. The financial market, the sentiment was quite down, sentiment was quite low. So to bring back that sentiment, the positive sentiment into the financial markets, to bring back normalcy, that was one challenge. Inflation by and large looked to be under, below 4%, around 4% or below. Growth was beginning to slow down. So that is why from the first monetary policy, February 2019, first monetary policy committee meeting for me, we reduced the rates by 25 basis points. So post ILFS scenario, growth slowing down. Growth is a challenge to, overall financial stability. So therefore, RBI from time to time is required to address that particular issue. And then, of course, the other challenges in the banking sector, etc., were there. And then came the pandemic. The pandemic suddenly, without any advance notice, threw up a lot of challenges. And at the Reserve Bank of India, with the cooperation of all my colleagues in the Reserve Bank of India, despite extremely difficult times in terms of restrictions on movements, in terms of need to follow COVID protocol, our effort was to remain as much as possible in sync with the requirements in sync with the challenges and their requirements, and try and be as proactive as possible. So that way, I think so far we have, I think, almost all the measures which we initiated during the COVID times, they seem to have worked. And at least that is our assessment. And I would believe that large number of analysts and experts outside also do share the same kind of assessment. But again, challenges always remain. Even as we are discussing today, the global situation is dynamic and challenges keep coming up. So we have to be, as a central bank, at any point of time, even now, we have to be as alert as possible to deal with the emerging and the challenges and the very fast-moving global developments.
Absolutely, Governor. I mean, you said it, the very fast-moving global development. So you spoke about past 3 years, and now let's looking forward. Inflation. Till recently, all the global bankers are talking about, describing a transient. Now the phrase change. They're calling temporary. Their approach is changing. You have already announced that from November tapering will start. Of course, Bank of England stuck to the old regime. Till now, there is no change. So tell us, what's the scene? What's your take on inflation in India? Incidentally, I mean, you have the government ears, sir. I mean, you have been talking about excise duty cut on petrol and diesel. It seems they have listened to you and it's been cut. That's the positive for inflation.
That is positive for inflation. In fact, that is significantly positive for inflation. And a number of supply side measures. You see, in India, the inflation originated from the food inflation. It was edible oil, it was pulses, and then, of course, the petrol and diesel prices, they sort of had their impact on various segments of the entire inflation basket. Now, and most of it was caused due to supply side factors. So supply side factors have been addressed by the government in terms of, particularly with reference to pulses, with reference to edible oil, and now very recently with reference to petrol and diesel. So all these have augured well for the inflation scenario. So food inflation by and large looks to be now under control. But again, food inflation always has the uncertainty built around unseasonal rains and unexpected weather events. But having, that is a risk factor, but food inflation looks to be very much stable now. So far as India is concerned, core inflation has remained elevated, and that is a policy challenge, and we are keeping very close watch over the evolution of the core inflation. And fuel inflation has also remained elevated, and so therefore we are very watchful with regard to core and fuel inflation. Food inflation, as I said little earlier, seems to have stabilized. Talking about the global scenario, yes, the language is slightly changing. Earlier they were saying that it is due to it was transitory. Now some of them are saying it is caused by transitory factors. The language is becoming more and more nuanced. So we have to see, we have to wait and see, watch the evolving situation. You see, energy prices have suddenly gone up. Nobody expected a sudden shortage of energy or the prices going up. Similarly, steel prices have gone up. Commodity prices, crude oil prices, they have gone up. But there is a sense, at least some people say that they seem to have peaked. But again, these are markets on which it is very difficult to project whether they have really peaked, but they seem to have peaked according to some analysts and experts. And so globally, therefore, inflation has to be very carefully watched for countries like India. So far as our domestic inflation scenario is concerned, whatever projection we gave in the last monetary policy committee meeting of, I think this year's, that is the current year, that is 2021 inflation at 5.3%. Our expectation, even at this point of time, is that it will be in line with our projection of 5.3%. And positive developments emanating from the petrol and diesel prices reduction, which incidentally we had not factored in to our 5.3 projection. That is definitely a positive development. And in a very fast changing scenario, one has to remain very careful and one has to be very watchful of the global developments as well as domestic situation.
Good to hear that, Governor, that you are saying that you will stick to your inflation projection and there is no downside risk because oil price cut you didn't take into account. Sir, tell us, you have been continuously saying that RBI will continue with its accommodative monetary policy till you secure growth. But certainly for the last few months, they talk about if you see all the macro numbers, if you look at it, high frequency data, it's talking about growth. I mean, there are commentators who are saying India is back on a growth path, something what we had seen between say 2006 and 8, 9% plus growth for 3 consecutive years. So how do you feel? Do you also see the same way?
No, definitely the growth impulses have become stronger. The fast moving indicators are looking very, very positive. And our assessment, again, as I said, in the context of inflation, our assessment is that the growth, the GDP growth in the current year, the 9.5% projection which we have given is, I think it is, we are on the path of reaching that 9.5% GDP growth, and that seems to be, quite achievable at this point of time. But then there are sort of headwinds originating from the external sector. There are global headwinds coming up with regard to, for example, the growth in the advanced economies, the most developed economy and the advanced economies, the growth which was very positive in the up to the second quarter of this calendar year, they seem to have moderated in the third quarter. The global growth projection of 5.9% given by the given by the IMF, that may or may not be achieved. I think the global growth there is a possibility that it may undershoot that 5.9% target, mainly because of factors like shortage of semiconductors, shortage of shipping facilities, shortage of ships, shortage of containers, charges around of the freight costs, and the container charges have gone up, and input costs have gone up, commodity prices have gone up, and COVID still remains quite high in many in many Asian countries as well as in many European countries. So therefore, global headwinds are very much there so far as India is concerned, but India's growth impulses are strong, and 9.5% for the current year should be achieved as it looks today.
Sir, I mean, from our conversation, I get a sense that you take some time to unwind. Tell me, I mean, aren't you afraid of repeating the same thing what happened during Dr. Subbarao's regime, taking the baby steps, and it was too little, too late?
You see, hindsight knowledge is always easy. And so, I mean, I'm not entering into a debate, but it's always easier to say things in the hindsight. So I'm not commenting on what happened earlier, but I think our action is very much in sync with the evolving situation. And I have said it in my last, in the last monetary policy statement, I have said it that we are sort of rebalancing the liquidity which is available in the system. And also this concept of unwinding, I think that is a much misunderstood concept. So unwinding means what? I mean, you had rolled out a carpet, you are rolling it back. It's not, so simple kind of an approach of sort of unwinding, giving out something and rolling it back. While we were announcing all these measures during COVID time, we were always constantly assessing the downside risks, the possible fallout, and to the best of our ability, we have always built in provisions to see that they have, they are given out for a finite period, and they automatically start, automatically they start getting, they sort of get rebalanced to the original situation. The term normalized is what you use. I'm not using the word normalized. I'm using the word rebalancing. Now, for example, the liquidity, which we injected into the system, the LTRO, the TLTRO, or for that matter, the CRR reduction, most of it have a sunset date. CRR was given out for 1 year. It has ended. So that much liquidity has come back from the system into the RBI. That much of liquidity is outside the system liquidity. LTRO, we gave, I think, initially for 3 years. Then TLTRO, we gave for 1 year, we gave for 3 years. So out of the total liquidity which was injected during the pandemic times, a large part of it has already come back to the RBI. Incidentally, the first one which we announced, I think, in February 2020, 1 lakh crore of LTRO, about 98 or 99,000 crores of that liquidity has already come back to the RBI. So whenever we injected liquidity, there was a sunset clause, and that it was for a finite period, and it has come back. What came, what sort of added to the liquidity situation was the inflow of foreign exchange. Now, obviously, to prevent, prevent excessive volatility in the forex market, the RBI has to sort of intervene in the forex market from time to time. As a result, that has added a lot of liquidity into the system. And we have already, I have announced it in, in our monetary policy statements earlier through the, the variable rate reverse repo auctions, 47 days, the fine tuning operations. Sometimes we make it for 3-4 days, the fine tuning operations, or the 7-day variable repo rate auction, the VRRR as I call it, 7 days, 14 days, 28 days. So through that, about 7.5 lakh crores is what we have notified. And against that, I think almost about a little less than 7 lakh crore is what is coming to us through the reverse repo window. So the liquidity is getting rebalanced, and the liquidity we have ensured in the system is basically a reflection of the monetary policy stance of accommodation. As long as the monetary policy stance is an accommodation, we will have to see that the liquidity is in surplus. But the excessive liquidity, as some people call it, we are trying to rebalance it in sync with the evolving situation.
Fair enough, sir. You are soaking up liquidity through different ways, and since the last monetary policy, the short-term rates have gone up. Be it CP, CDs, treasury bills, all have gone up. Also, you have stopped that GSAP. There is no more GSAP thing and all. So, is this a new reality now? I mean, you are not raising rates. That's fine, but this is the way to actually, to quote you, bringing back normalcy. You are not very comfortable with the term unwinding, so you said something else. Or is this the way? Like, we'll not see. We'll find Reserve Bank of India just watching, but short-term interest is going up. GSAP is not happening. That's the way
You
forward.
see, so far as the rates are concerned, the overnight money market rates, including the tripartite repo and the the tripartite repo, or the overnight repo, etc. They are hovering around the reverse repo rate of 3.35%. The weighted average reverse repo rate is, of course, little higher, but all the overnight money market instruments are hovering around the reverse repo rate, as I mentioned, at 3.35%. So far as the 7-day or 14-day or 28-day reverse repo are concerned, we are now letting the market function. Let the market determine what is the yield. So we are not sort of doing the kind of active interest rate determination as we sought to do last year through GSAP and through sort of explicit statement that mainly through GSAP. Now we are letting the market to function. So therefore, you would have seen that this has brought in a lot of orderliness into the market. Even in the GSEC segment also, we are letting the market to function, but that doesn't mean that we will just we will accept if suddenly the interest rates go up very steeply. But by and large, the market evolution of the interest rates, even in GSEC market, they seem to be quite orderly. They did go up in between. Let's say, for example, the 10-year benchmark security went up to about 6.39, but they have again come down to 6.3, 6.31, 32, like that. So therefore, I think the market has accepted the reality, and perhaps there is greater synergy in thinking. I don't know. Perhaps there is a greater synergy in thinking between the regulators, between the RBI's expectations and the market behavior. And the market is, I think, functioning in a very orderly fashion.
So here is what here is what Reserve Bank of India Governor Mr. Das saying, that he is happy with the market determined rates. I mean, unless it's called for, you will not intervene.
In the sense that the markets, particularly for the reverse repo liquidity management, we are letting the market decide.
Absolutely, RBI is letting the market decide the short-term rates. Sir, you only raised the problem of plenty in the forex market. the Dutch disease people call it. So is it something we had seen post Lehman? You think it's a real problem of plenty? How do we tackle it?
No, not really. You see, most of our most of our forex reserve which is built up, it's not because of we are a current account, it's not through the current account surplus. We are still a current account a deficit country. Last year we were surplus because suddenly the crude prices went down and it was a different scenario altogether. But basically we are a current account deficit country, so therefore our reserve accretion is happening because of capital inflows, and whenever there is a capital inflow there is a corresponding liability outside. So therefore the level of forex reserves that we have, it is adequate. It makes us, it puts us in a very comfortable position. It gives us greater confidence to deal with any volatility should it happen because of taper or because of withdrawal of unwinding, as you call it, the unwinding of policy by the advanced economies. So that way we are much more comfortably placed today to deal with any volatility in the forex market. And there will be step, it is our endeavor, as I have said earlier, and as has been the policy of RBI will be in a position to ensure stability in the forex market. We will not see the kind of challenges that India encountered during the taper tantrum of 2013. But at the same time, the forex reserves that we have a corresponding liability, and that is something which we must always keep at the back of our mind. So therefore, and we have to keep at the back of our mind the fact that we are a current account deficit country, which is actually, I mean, being current account deficit is it's at one level it's quite good. That means you are getting capital from outside. There's a net accretion of capital from outside. Instead of exporting capital, capital comes into the country. So it helps us to finance our deficit, the current account deficit.
Governor, from markets to RBI's own balance sheet, you also alluding to it in some way. One of the commentators has recently said that RBI may require capital to keep up with the Bimal Jalan committee recommendations. And this year RBI has bought a whole lot of bonds and dollars. Its balance sheet has expanded by close to 6 trillion, 5.9 trillion. The government will have to infuse about 57,000 crore capital to meet that 20.8% capital requirement which Jalan committee has recommended. And of course, if the rupee appreciate, it will further lessens your capital, which means you will require more capital. How do you address it?
I think, at this point of time, it's a purely speculative question. And the year is not over. The year is up to 31st of March. There's still 4 months to go. So we will be able to reach a conclusion only when we reach the end of the year. But this kind of projection, I mean, that there will be a situation where government has to inject capital, etc. I think it's a very, that kind of a situation will not arise. It's a very, very extremely alarmist projection, I must say. We do not foresee such a situation. But having said that, let me say that we will know exact position at the end of the year. It's not correct. It's not possible for me, and it's not correct for me to sort of prejudge and say that, okay, this will be the year-end position.
Or probably you would not be as liberal as you have been in passing on the dividend or a surplus to government.
No, that will depend on the accounts. That will depend on the year-end figures. And I have no idea as to what would be the year-end figures. It's a function of the market primarily.
Okay, sir.
With regard to, let me make it very clear, with regard to government to sort of infuse capital, etc., I think it's a very, that kind of a situation will not arise.
Okay, sir, from markets to RBI's balance sheet and monetary policy, let's shift to something else, in the banking segment. Now, our bank's retail portfolio is getting fatter. As we speak, overall banking industry's retail portfolio has surpassed the corporate loan portfolio. Now, home loan rates are at historic low. I'm quoting July 30th figure, outstanding retail loan 28.58 trillion, outstanding loan to industries 28.24 trillion. Now, what does that mean? I mean, then where do the corporates go? I mean, is it you think that we have enough deep bond market which can cater to the needs of the corporate world like the developed markets? That's one side of the story, and the other side of it, sir, there is so much of focus on retail. At this point of time, home loan rates are at its historic low. As things normalize, as things, and there'll be at some point where we don't see the rates at the current level, it will go up. So do you see that the banks are staring at sort of the risk of rising defaults in the retail case? There are two parts of my
You see,
question.
the loans will go where there is a demand. So obviously at the current juncture, there is a demand for housing loans, and that is primarily emanating from the revival of the real estate sector because of the liquidity and other rate reduction which RBI has done. And there is a growing appetite for, especially one of the fallouts of the pandemic, that people are now wanting more space in their homes because they realize that there will be a lot of time where they have to work from home. So therefore, people are looking for slightly bigger places in their residential accommodation. So there is a demand, and loans will go from to the sector where there is a demand. Second point I would like to mention is that again, because of the the liquidity that we have made available to the system because of the reduction of policy rates by RBI, the retail housing rate, the housing loan retail rates, interest rates are at an all-time low, and that is also really fueling a lot of that is also not fueling, but that is also incentivizing a lot of borrowers to avail housing loans and sort of buy bigger houses, bigger flats, or bigger accommodation than they have. And this is at the right time for people. People have chosen, those who do not have a housing property, they like to go for some facilities. So therefore, basically, there is a demand coming up from the housing sector, which is in turn driven by the liquidity situation and by the interest rate situation. That is fueling some amount of demand for loans. And the retail sector or the real estate sector has also is sort of is witnessing some growth. So therefore, as to repeat again, first, loans will go where there is a demand. The demand is coming from the housing sector, and the reasons I have explained to you. The second thing is that while the banks sanction loans, obviously the risk pricing has to be done very carefully. It is for every bank or for every financial institution like NBFC or anyone else. When they sanction loans, they have to see their total loan portfolio and what percentage is going into retail, and out of that, what percentage is going into housing retail and what percentage is going into other segments of the retailing market. So based on that, each bank has to do its own due diligence and has to determine its own risk appetite and has to do its own risk pricing. So therefore, it is a function of risk pricing of the banks, and whether the retail portfolio is becoming unduly excessive in the total loan portfolio is something which the risk management committee of the banks will have to really determine. And in my interaction or in RBI's interaction, in fact, this is one point which we have been stressing time and again, even in the recent, on the 2nd of November, we had an interaction with all the bank CEOs, both public and private sector. And again, we have stressed upon this issue that the risk assessment, the risk management of the banks need to be very sharp, and it is for the banks to do their appropriate risk pricing. What percentage of their loan portfolio, loan book should go for retail, and within that, what percentage should go for housing is for the bank board to decide, the bank board to apply its mind and do the risk pricing. So, and my sense is that the banks are very much aware of this aspect, and they are accordingly pricing the risks, and accordingly they are regulating the loan disbursements. So far as corporate loans, you said you cited a figure whereby the corporate loans are almost the same as the retail loans. Now, so far as the corporate loans are concerned, at the moment you are right, the demand for bank credit from corporate sector is not as robust as one would expect. Now, there are two sides, there are two aspects in this. One, over the last 1 year or so, the corporates have accessed more funds from the bond market. They have gone for more number of bonds, debentures, commercial papers. So they have accessed market resources more than bank funding. And I think That is a very positive development. All these years we have been saying that the corporate bond market is not growing. But last year the corporate bond issuances were very high, even in a pandemic year. So that is a positive sign that the corporates are looking at the market. And when they go to the market will determine, decide its risk and will price the bonds accordingly. And so that's a positive development which is happening. So far as bank credit is concerned, our interaction with the banks show, and I think you have sessions coming up with eminent bankers immediately after this session. In fact, I must compliment you for over the last few days bringing together experts from so many aspects, from so many segments of the overall financial sector, and bringing all the experts and having this discussion. So the group of eminent bankers who are, leading bankers who are participating in the subsequent session today, you can check with them. Our sense is that next year, there are signs of investment pickup. There are signs that the demand for bank credit will pick up from next year onwards. And this is a feedback which I have got from the banking sector. And that is our understanding also. But again, time will tell how it plays out. So therefore, I think overall, what I would say is that I said three things. One, I said that yes, RBI's policy and the overall situation has triggered growth of housing loans, which has really helped the real estate sector. Number two, the banks are doing, and they need to focus more on risk pricing of retail loans and housing loans and automobile loans and the others. And third, if the corporates are going to the bond market, that is a positive sign. And fourth, bank credit, especially investment credit, demand from the corporate and industrial sector is expected to pick up from next year onwards.
That's what RBI governor is saying, that demand for corporate credit is expected to pick up from next year. Good to hear you, sir. Tell us, from corporate loan to corporate entry into banking. It's almost about a year RBI working group spoke about corporate entry into banking, but you are keeping quiet. So now your second term is coming up months down the line. Do you see any development?
No, I'll explain. You see, we got the internal working group gave more than 30 recommendations, 30, more than 30 recommendations. And we have got, hundreds or perhaps more than 1,000, 1,000 responses which have come to various aspects of these 30 odd recommendations. And each of those recommendations and the inputs will have to be very carefully examined. Other things have also kept us busy, particularly in the regulatory side. We had a list of agenda items which had to be attended. For example, in the Urban Cooperative Bank, we came out with certain set of guidelines for governance, for certain other regulations we have come out with. Recently, we came out with the scale-based regulation for the NBFCs. We have also come out with a governance a set of governance guidelines for the scheduled commercial banks. And so this is one thing, the internal working group's recommendation. It is under examination. And I mentioned the complexities involved in terms of the number of inputs which we have received, the number of recommendations. We are examining it, and we will it is under examination, and we will decide on it going forward.
Okay. Sir, what about the normal banking license? Because there are license seekers, and you have opened the window for universal bank. 2015, the last time 2 banks got license. Then you gave the payments bank and small finance banks. When after that lot, at least 2 small finance banks got licenses. But RBI is not pushing at all for the new bank licenses. So do you think that we don't need it at this point of time? It will take some time, or what is the regulator's point of view?
You see, we have received number of applications for setting up scheduled commercial banks. We have put out the list of applicants in the public domain. It was released, the list was released some time ago.
Yes.
And as you know, we have got an external advisory committee under the chairmanship of the former Deputy Governor, Ms. Shamla Gopinath. So all those applications which we have received, whose list has been put out in the public domain, they have been referred to the external advisory committee. And as soon as we get the recommendations of the external advisory committee, we will take a decision. The sense I have is I am given to understand that the external advisory committee is having, they have been meeting periodically and they are evaluating the applications. And as and when we get the the recommendations of the external advisory committee, we will scrutinize them and take a call. It is on tap. Anybody can apply for a bank license at any point of time. They have to be examined from the point of view of the fit and proper criterion which we have.
So you don't have any time frame in mind, right?
No, we don't have any time frame, but usually, typically, if you see, it takes something like 6 to 8 months at least, because you are, it is not just in-house work. You depend on inputs from lot of external, so various external authorities and agencies. We get inputs from them, so we have to follow it up with them. We have to get their inputs. Sometimes, if their inputs do not give the full picture, we again write back to them. And I mean, we have to basically do the fit and proper test for individual applicants, and the individual applicants would have a banking history, would have a business history, so we have to go into all that.
Sure. So, Governor, talking about digital disruptions, fintechs are challenging the banks. Even some of the platforms are raising deposits on behalf of the banks. I can put in money for a bank deposit, but on a platform. So I have two questions. Do you think, what is RBI thinking? Is it a threat to the traditional banks? Even to some extent, there could be threat to financial sector stability. That's one part of it. And other part is this. I am taking the liberty because you are a very liberal governor. You believe in consensus approach. You encourage questions. So, is RBI well equipped to
No,
handle?
please ask me the most uncomfortable question. I have no issues.
Sir, but does RBI need kind of put its house in order and take a relocate it about its capability of managing this new digital world?
You see, we have set up a department of fintech in the RBI I think about 2 years ago. In the Department of Regulation, we have enough capacity. And as a part of our Utkarsh 2022, we have a roadmap for augmenting the skill levels and augmenting the staff in the RBI. It's a continuous process. We keep on evaluating the required skills and whether we have them or we need to, train our people in new skills. We keep on evaluating whether we have adequate number of people, and we we keep on recruiting the people. For example, in the Department of Supervision, we have substantially augmented the staff. Similarly, in fintech also, we have set up the fintech department, and we are working on augmenting and enhancing our skill sets. So RBI is well equipped, and RBI will be able to deal with the situation. But purely from a regulatory and supervisory perspective, the digital world is constantly throwing up new issues and new challenges for the regulator. And you mentioned about banks collecting deposits through certain digital platforms, etc. That's a new regulatory, that's a kind of a new activity which has now come up. So from the regulation point of view, we are studying that model, and certain activities even now the banks are permitted to outsource. So we are studying that business model. We are studying what kind of agreements are there between the banks or the small finance banks on the one side and the digital platforms or the digital players on the other side. What kind of agreements they are entering into, and what kind of regulatory challenges they have. Whether in any manner the integrity of the financial sector, the integrity of the banking sector or the financial sector, you refer to financial stability, whether the integrity of our financial sector and the stability of the financial sector, whether that has any possibility of getting underlined. So at the moment, it is, we are examining it very closely, and if required, I'm saying if required, RBI will come out with additional regulatory guidelines. Now, so far as you mentioned about threat to banks, you see, these are not threats, these are challenges to the banks. And the only conclusion that I draw from this challenge, and I'm sure the banks also will draw a similar challenge, similar conclusion from this challenge, is that the banks need to be tech savvy, they need to be in sync with the technological changes. The banks need to invest appropriate amounts of money in upgrading their technology facilities, technology infrastructure, and technology capabilities. So it is an opportunity for the banks to really harness this digital world, the benefits of the digital world. The banks will have to really harness, and you know, if I mean, it will be kind of the banks will have to really take the lead and harness the benefits and capitalize on these. The bank should see this as new opportunities, and this challenge itself is an opportunity for the banks to sort of move to remain in sync with the modern times.
The banking community is listening. Sure.